Hi everybody, today I'd like to share with you what is increasingly quickly becoming my favorite asymmetric setup in the markets through a multi-quarter lens, and it has to do with what's going on in the interest rate markets and how this is likely, in my view, going to manifest itself because of the Fed's sort of dovish tone, at least going forward. Before we look at the actual trade, let me give you a little bit of perspective, and I know not everyone's paying that close attention to the interest rate market on the retail front, but this is important to watch. So what you're looking at here is something called the yield curve, and currently the yield curve, so this represents the yield of different maturities of the U.S. interest rate markets on the government yield curve, I should say. And you can see what we're looking at is essentially a normally sloped yield curve from the 2-year maturities, or 2-year treasury notes are yielding less than, let's say, 10 or 20-year and 30-year treasury notes. That's what's called a regular yield curve. What's not yet regular is that the very short end of the yield curve, so basically Fed funds, the Fed funds rate or the effective Fed funds rate is actually way above, let's say, the 2-year. And we think that as the Fed starts lowering rates over the course of the next few quarters, that we'll likely see a further shift lower, not only there but also on the 2-year part. So let's look at this a bit more closely. Now, keep in mind that bond yields and bond prices have an inverse relationship. So if I think that 2-year yields are going to go lower, I'm expecting that the price of 2-year treasury notes or futures thereof or ETFs that track it are going to go higher. So I'm going to show you this to you in yield terms because that's how bond markets essentially trade. So to show you this, what I've got here, this is sort of the next, the same chart that I showed you but in a different way. The green line here represents basically Fed funds rates. So this is the very short end of that yield curve I just showed. You can see it's trading above in terms of yield where the 2-year yield is. So, but I'm going to get rid of this green line here so you can see it a bit better, what I'm trying to share with you. Now, let me turn this whole thing into a much longer term chart. I'm going to turn this into a weekly chart, and here we go. So basically what you can see here is this goes all the way back to the late 1980s. And we made a big deal about this over the past few years. We said that when rates started breaking out of this long-term downslope, when they started breaking higher as the Fed started hiking rates in 2022 due to inflation, we said that this was a pivotal moment for rates going higher. However, that does not mean that rates can't go lower through a multi-quarter lens for the time being. And so while we think this breakout there was important and rates are going to remain higher for longer, which is basically this breakout point here, we don't think rates on the 2-year part are going to go back to like 1% or anything like that, but we do think they could go from the current levels around 3.4%, maybe down to, 2.5%. And that's, believe it or not, a pretty big move if we look at it in the right context. So what I'd like to share with you now, I'm going to get rid of this line here because we need to zoom in a bit closer, is essentially a behavior in yields that has played out over and over again. And again, we don't think we're going to go to lower lows in rates here, but it's more of a mean reversion move. So you can see every time that rates spiked and went vertical, be that back in 2005, be that back in basically the turn of the century, back in 2000 and the year 2000, I should say, excuse me. And again, we could do this exercise. I could draw all the other ones. We're having a very similar setup here once again, or even back in 2018 when the Fed started cutting rates, right? There's one common denominator here, and that is that at some point the Fed, as I said, had to start cutting rates again. So basically we saw rates go lower, rates go lower, rates go lower, and of course now we think the similar setup here. To make this a complete picture, I'm going to draw the line here as well. So we think rates are going lower. And so basically what I want to do is I want to be essentially long the 2-year bond, or again, this could be done with an ETF, like for example, I don't know, there's 2-year notes, ETFs out there that can be used to trade these. Even SHY would work probably for something like this, the ETF. Or of course, if you're a futures person, the trade that I like, it's not a recommendation, obviously just purely educational here, would be to basically be long 2-year futures through, again, a multi-quarter lens, where I would expect that these yields will break lower. The difference, however, between what we've seen over the past 30 years of the bond bull market, basically coming out of the 70s and now, is, again, we don't think that rates are going to make a lower low, which they did make for a long period of time, but we do think they're going to go lower enough for this to be a meaningful size trade. I know this might be a lot for some of you to digest, but the bond market ultimately drives a lot of stuff. So the 1 to 3 year sort of maturity spectrum of the ETF. The ETF that tracks that, I should say, is SHY. So again, if I think that 2-year yields are going lower, remember there's an inverse correlation between bond price and bond yield. So if I think that bond yields are going to go down, I'm thinking that price, which can be measured by the SHY ETF, roughly it's the same idea, would go up. So the idea would be to basically be long SHY as well. Now, SHY doesn't give you a lot of leverage. A lot of people are used to fantastic returns over the past number of years. So the SHY, there's options on that. Again, the futures market is probably a bit more where this could be played. There's probably levered ETFs on this stuff as well. I don't know. But anyway, this is something I'm really enjoying right now. Is something I'm still researching. I haven't, in full disclosure, not yet positioned myself, largely because I've been traveling for the past week and a half or so. But something I really like. And if you have any questions, please leave a comment or shoot us a note over on the website. If this video helped you, please make sure you subscribe to the channel, you give us a thumbs up, like, and if you want to see this approach in action, you will want to join us in our Set the Market morning call, which happens at 9 o'clock Eastern Time, Monday through Thursday. Make sure you join us for that in the link down below. Again, subscribe to the channel. I'll see you in the next video.